Hello, and welcome to topic 7, part 2. So here we will be talking about revenue recognition for the long-term contracts. Right, so starting with what a long-term contract really is. So these are the long-term contracts, as the name suggests, that will span over multiple years. So one of the challenge when you're looking at a long-term contract is when do we recognize revenue? And this is what this topic is focusing on. Okay, so here, when a company has a long-term contracts, they are performing the work as they go, and the companies do have the ability of billing the customers as they go through the progress of work completed. Now, when that revenue is recognized, whether that happens at a single point in time after the completion of the entire contract, or as the company goes through that year-to-year contract, when to recognize that revenue, that primarily depends on the structure of the contract. The contract is going to dictate when the revenue is going to be recognized. So under IFRS 15.35 standard, a company can recognize revenue either over time or at a point in time. But if they are trying to recognize it as they go, because keep in mind that the companies want to recognize revenues as they go. For example, if they have a 5-year contract, the company does not want to wait 5 years to recognize revenue, which will be at a single point in time. If the contract dictates then that's what it's going to be. But the companies prefer to recognize that revenue as they go so that they don't have years without the revenue, right? So that is what we are talking about here. So under IFRS 15 standards, the company can recognize that revenue over time as long as they are reasonably able to estimate the progress towards completion. And in order to determine that, we have these 3 criteria that needs to be applied, which is the customer receives and consumes the benefit as the seller is performing. Does the customer has the control of the asset? Does the company that is performing the work has any other alternative use for that asset and has a right to the payment of the performance? If none of these 3 criteria is met, then the revenue has to be recognized at a point in time. For example, the same long-term contract we are talking about, at the end of the 5th year is when the company will recognize that revenue. But if these criteria are met, then we are looking at recognizing the revenue as we go. And we are just looking at any one of these criterion to be met. Not all 3. If all 3 happens, great, but at least one. Now, when we talk about ASPE, under ASPE, the revenue recognition is very general. So there we just look at the completion of the work. Okay, so as your work is completed on a long-term contract, this is viewed as continuous sale. So when you think of a continuous sale, the company is looking to recognize the revenue. If you have the revenue, you definitely have the cost associated to that, as well as the gross profit. Okay, once again, the amount of revenue, cost, and gross profit that will be recognized really ties to the amount of work that has been completed. So what is the performance that has been completed up to the point of recognition? So in order to do that, we have 2 ways we can account for that. One is the percent of completion method, where the revenue is going to be recognized over time. Now, under IFRS method, we also have a zero profit method where the revenue is going to be recognized only to the extent of the recoverable cost. Under ASPE, we have a completed contract method where the revenue is going to be recognized after the performance obligation is met at the end of the contract. So that's why we have 2 methods under IFRS and ASPE. Now, these are some of the examples that discusses the long-term contracts. So the first one is a 3-year contract to build 50 planes. So if you're generally looking under IFRS, then this is going to treat as many performance obligation. So as each plane is completed, a performance obligation is completed, and hence the revenue can be recognized. And exactly that same idea applies under IFRS 15 standard, which focuses on revenue recognition on long-term contracts. So there are multiple performance obligations for this particular contract, and revenue will be recognized as these performance obligations are completed. The next one is your construction of hotel in downtown. Now, this is a single performance obligation. So none of the three criteria we discussed in 15.35 are met. Hence, here the revenue has to be recognized once the work is fully completed, that single performance obligation is met. So at the end of the contract, that is where your revenue is going to be recognized. Third one is construction of satellites where company cannot sell to anyone else and has right to payment, or construction of luxury cottage on customer owned property. Now, if you again think of those three criteria in 15.35 we discussed, one of those criteria is met here. The company does have the ability to collect payments and they do not have any other alternative use for this asset. So this is going to be treated as a single performance obligation under IFRS. So the revenue will be recognized at that point. Under IFRS 15, the revenue can be recognized over time, but we will have to figure out how much work is completed. Now that can be done either based on the percent of completion method or under the zero profit method, where the revenue will be recognized at the end of the contract. Either of those two is good here. The last one here is the 2-year contract to provide cleaning services on a monthly basis. Now, under IFRS, this is going to be treated as a single performance obligation, but under IFRS 15 standards, you will have many distinctive performance obligations on a long-term contract here. So as the work is completed, the revenue can be recognized, but again, the company will have to determine how much work is completed. So they can use the percent of completion method. Now, this slide talks about how we are going to deal with the accounting side of the long-term contract. So as the business is incurring expenses or costs, we are going to debit our contract asset or a liability account, and the credit goes towards cash, inventory, accounts payable, or any other account. It all depends on the scenario, okay? Now here, keep in mind your contract asset and liability account is a single account. If the end balance in that account falls on the debit side, then we treat that as an asset. If the ending balance falls on the credit side, then we treat that as a liability. But that will be one of the primary account that is used for the long-term contracts. So be very mindful of that particular account. Now, during the long-term contracts, often the companies do have the ability to bill their customers as they go. That is referred to as progress billings. So the journal entry for that is debit to your accounts receivable, and credit again is to that same contract asset or a liability account. When the customer pays towards these progress billings, you are crediting accounts receivable, but the cash comes in, so we are debiting the cash account. Now, that accounting treatment will be the same whether we are using the percent of completion method or we are using the completed contract method. So the first 3 journal entries are going to be the same as we go. But if the business is using the percent of completion method, then at the end of the year, they are going to recognize the revenue. Okay, and that really again depends on the method the company is using. So the percent of completion method has different ways of calculating that. We will talk about that in the following slides. But once the company determines the amount of work that is completed, they are going to recognize their revenue. So they are going to debit their construction expense, the amount of revenue that they have determined that can be recognized for the year that goes to credit account, which is your revenue from the long-term contracts. Your plug between the revenue and the expense is that same contract asset or liability account that we discussed here. That can either be a debit or it can be a credit depending on how the numbers are flowing. So always do your expense debit first, your credit to the revenue account second, and lastly, your contract asset or liability account is going to be a plug, which can either end up being a debit or a credit. Likewise, under the completed contract method, here the company is not recognizing revenue up until the contract is completed. That is why they don't have to do any year-end revenue recognition in this case. Now, on the long-term contracts, there often can be cases where the contract price is lower than the total cost. Okay, or alternatively, you can say that the total cost of completing a long-term contract exceeds the contract price. Now, if the company does not have the ability to change these contract prices, then we are looking at an unprofitable contract, which is referred to as an onerous contract. And again, keep in mind that all of this is determined by the terms of the contract. If the business is able to pass on these additional costs back to the customer, then you don't have an onerous contract. This is recoverable cost then. But if the contract price is set and the contract has no way uh, to pass that additional cost to the customers, then you're looking at the onerous contract. Okay, so with the onerous contract, then the question is, how do we treat those losses? Because this will be a loss-making contract. So that again ties to what method of revenue recognition is the company using. If the company is using the percent of completion method, then they are going to reverse all of the revenue they have recognized up until the year of the loss. And then they are going to take 100% of the loss in the current year. For example, in 2022, if the company recognizes or has the loss, they will have to take 100% of that loss in this year. If they have recognized revenue in 2020, 2021, then they will have to reverse all of that revenue under the percent of completion method. Okay, the idea or the most important piece to remember here is that 100% of the loss has to be booked. Even under percent of completion, your revenue is recognized based on the percent of completion. But when we talk about the loss, it has to be 100% of the total loss that needs to be recognized in the year it becomes evident. That same logic applies to your zero profit or the completed contract method as well. We want to recognize 100% of that loss. But under this method, we have not recognized any revenue in the prior year. So in 2020, 2021, for example, we had not recognized any revenue because we were waiting to do that at the end of the contract. So in that case, there is no reversal of the revenue, but yes, we still have to recognize the 100% of the loss in the current period where it becomes evident. Now, how do we go about the percent of completion method? So percent of completion method, we are trying to determine what is the amount of work that has been completed, and that is going to dictate the amount of revenue we are able to recognize in those years. Now, in order to do that, the companies have two ways of going about this. So either they can use the input-based method, which is also called as cost to cost. So we look at the total cost incurred up until the year end divided by the total cost to complete the project or the contract. That is your input-based method or your cost to cost method. Now, this can give you disruption in the input units. The reason being that there could be front-end loading. For example, if you're talking about building a contract to construct a building, now that's going to take, let's say, 3 years. A good chunk of the work will go initially into that to put in the foundation, to lay the groundwork to start building or start construction of the building. Okay, that is front-end loading. Now, that can actually lead to higher cost estimates for completion. So that is the drawback of your input-based method. Alternative to that is the company can track their output. So they can track their output results as to what they are creating. So for example, the amount of tons that are produced or the highway, kilometers of highway that they have built. Okay. Now that can also be inaccurate if the units are not uniform from year to year. So both of these methods have goods and bads. For this particular course, we will be focusing on cost to cost method when it comes to calculations, but we are expected to know the basics of both input-based method as well as output-based method. So the most popular one is the input based, that is also called as cost to cost, and that is what we will be focusing on here. Now, how do we go about the calculations? So when we are looking at the percent of completion, we are trying to see what amount of work has been completed in comparison to the total. So if you look at the total cost that is incurred to date divided by the total estimated cost for completing the whole contract, that will give you the percent of completion right from day one up until the end of that year. If you multiply that percent of completion with the contract price, then we can determine the total revenue to recognize to date. Your gross profit is your contract price minus your total estimated cost. Keep in mind, when we are recognizing revenue and cost year after year, we need to recognize the revenue and cost for the current year, not for the total. So all of these calculations have to be adjusted for the annual amounts. Let's talk about your ethical consideration related to revenue recognition. Recognition of revenue is a very tricky area. So when you're thinking of the long-term contracts, there is a lot of professional judgment that goes into determining the amount of work that is completed, the total cost that will be needed to complete the long-term contracts. So the accountants end up using a lot of professional judgment when it comes to long-term contracts, because there can be a tendency for the management to have the bias for the financial reporting. We have to be really careful when we are looking at revenue recognition and the ethical implication of that. One of the very common areas of concern is that the compensation for the management team is generally tied to the net income. Now, in order to enhance that remuneration, the bonuses pay out. If the net income is higher, the bonuses will be higher. So how do we make that net income higher? Is either we can inflate the revenue by saying we have completed more amount of work, or we can reduce the expenses. Okay. Likewise, there is also a strong desire to meet the financial analyst expectation if you're talking about the IFRS companies. So in that case, again, that bias can exist. The lending agreements or the contracts also can often require some financial benchmarks are to be met. So in order to make sure that those benchmarks are met, again, the management can tweak these numbers to pretend like the benchmarks are met when they're actually not, okay? Because that affects their contractual obligation and the assessment of performance obligations. Let's talk about the disclosure requirement presentation and what are the fine differences between IFRS and ASPE related to our revenue recognition principles here. So when you're talking about your contract asset and liabilities, we said that this is a single account. If that account ends up with the ending balance on the debit side, then you're looking at a contract asset. If that account ends up with the balance on the credit side, then you're looking at contract liability. Nonetheless, that contract asset and liability, contract asset and or liability account will sit on your statement of financial position. Now, if the company has a contract liability, then the company has collected more money or has done higher amount of progress billing to the customers. So they have billed in advance of the work being completed. That's why it is a liability. If the company has completed more work in comparison to the billings to the customer, then they have a contract asset that will be recognized over time. Okay. Nonetheless, contract asset and liability account is going to sit on your statement of financial position. Now, when you're looking at your contract asset, that contract asset could either be the unconditional right to receive the consideration, which is our receivables. If it is a conditional right to receive the consideration, then it is a contract asset. Now, the cost that is incurred to obtain the contract. Okay, when we have a long-term contract, the company is going to incur different types of cost. That is what we are talking about with this slide as to where that cost sits and how do we treat that cost. So if we are looking at the contract cost or the cost that the business has incurred in order to obtain a contract, this happens before the contract comes into play, right? So for example, if we have the cost, legal cost, let's say, that is related to finalizing a contract, the question here is how do we treat that cost? So in this example, that cost is going to be treated as an incremental cost, meaning that the cost would not have been incurred if the long-term contract did not happen, right? So that is the cost to obtain the contract. So that cost can be treated as an asset. But if you have any other cost which would have been incurred regardless of whether the contract came into play or not, then it will not be treated as an asset, then it will just be an expense. So it is important that we understand that distinction. So if we have a bunch of different items thrown at us to say, how should this cost be treated? We should tie it back to, would this cost have incurred if the long-term contract did not come into play? If the answer is yes, then it's an asset. If the answer is no, it's a generic cost, it would have incurred regardless, then it is an expense. Then comes your cost to complete the contract. That is referred to as your fulfillment cost, and that is treated as your asset as long as we can relate that cost directly to the contract. That cost is going to enhance or create economic resource that can be used in the future, and the cost is recoverable. If those criteria are met, then we will treat that cost as asset. Any other general and administrative cost that is incurred will be treated as an expense unless, of course, the cost can be recharged back to the customer. If you can recharge it back to the customer, treat that as an asset. If we are not able to charge it back to the customer, for example, we have the wasted material, any excessive labor forces, money that we spend on training the labor forces, in order to produce a certain item, well, then all of that is expense. Revenue recognition disclosure. So when we talk about the disclosure requirement, it is quite extensive when it comes to IFRS 15 in general. The basic idea here is that we are trying to make sure that our users understand what is the nature, amount, and the timing of this revenue, because the revenue has a lot of uncertainty attached to that. When you are thinking of your percent of completion method, keep in mind that there is a lot of uncertainty there because it is based on estimates. So we want our users to recognize that and be aware of that. And that is why there is heavy emphasis on disclosure requirement under IFRS 15. So here we have to indicate the contracts with the customers in the notes disclosure. So we are not just looking at the quantitative information to be disclosed, but we are also looking at qualitative information to be disclosed so that the users can make correct decisions. Okay, so we will be disclosing the contracts with the customers, significant judgments that are playing into these calculations, and any assets that have been recognized for cost incurred to fulfill these contracts. So generally speaking, then the disclosure type requirements is disaggregation of your revenue, reconciliations of your contract balances, which really is we start with your contract asset or liability account, the beginning and the ending balance, and we reconcile that to show where those differences are. What are your remaining performance obligations? What is your total cost that we are expecting to fulfill the contract? Your users need to understand how much of more cost to expect in order for completing these contracts. Okay, what is the other qualitative disclosures? What was the significant judgments that were used? What are the assertions that we are using in making these assumptions? So all of that information is disclosed in your notes. And lastly, we are looking at our comparison between IFRS 15, which is your revenue recognition standard that we have focused on here, in comparison to ASPE. ASPE is a fairly easy approach when it comes to that. For revenue recognition for ASPE, we are looking at earnings approach. Earnings approach really is we are looking at risk and rewards. If the risk and rewards have passed to the customer, then revenue can be recognized as long as we can measure and there is collectability ascertained to that revenue. We go ahead and recognize the revenue. Under the IFRS 15, we are using a contract-based approach, and that is where your contract asset and liability comes into play. And we have a 5-step approach that we use here. And that 5-step approach really is, the first step is that we are going to identify the contract with the customer. Second step is to recognize how many separate performance obligations exist in that contract. Third is to determine what is the total transaction price. Step number 4 is to marry step number 2 and step number 3. So for each of the performance obligations that you have determined in step 2, we are going to allocate a portion of your transaction price that is calculated in step 3. Okay, so what does completion of each of these performance obligations mean? Because as soon as that performance obligation is completed, then we can recognize revenue. So that is your step number 4, which is allocation of your transaction price to each performance obligation. And step 5 finally is to recognize that revenue as these performance obligations are completed. That is the 5-step approach that we are focusing on in IFRS 15. So we are going to recognize the revenue when performance obligation is satisfied. That means the control is passed. Recognize revenue for each distinctive performance obligation at a point in time or over time. And if you're providing goods and services together, we need to consider if the performance obligation is interrelated, as in they are separate or they are together. That will help you determine how many performance obligations exist. Assurance type of warranties are accrued cost and liabilities, and service type of warranties are treated as separate performance obligations. We did discuss this in part 1 recording. Under ASPE, your warranty cost historically is treated as an accrued cost or obligation when the revenue is recognized. Okay, this slide also summarizes our IFRS 15 and ASPE differences, but primarily this is again where we are talking about the 5 steps under IFRS 15. So the transaction price is the amount that the entity expects to receive. There is a lot of emphasis on the measurement models that focuses on quantifying the risk and uncertainty that is attached to revenue recognition. Now, if you have any variable considerations, then the revenue is recognized only if it is highly probable that the future reversals are not going to incur under IFRS 15. And your transaction price for the transaction with multiple elements is allocated under relative fair value method. And that is what we will be using in class. So keep in mind, again, your IFRS 15 focuses on the 5-step approach. First one is to identify the contract. Second is to look at the number of performance obligations that exist. Step 3 is looking at your total transaction price. Step 4 is to allocate that total transaction price to each of the performance obligation we have identified. And step 5 is to recognize revenue as those performance obligations are met. That, my friends, is revenue recognition on long-term contracts. We will be looking at more examples in class that will help us solidify the understanding. Thank you for listening.